Something has just shifted in North America, and almost no one saw it coming. Mexico, a country long portrayed as the obedient partner of the United States, has just played a move no one expected. It didn't fire a missile, shut a port, or block trade. It struck at the heart of American power: its debt. While Washington brags about tariffs and boasts of economic strength, Mexico launched a quiet counterattack. A surgical move requiring no armies, only financial intelligence. The Bank of Mexico began selling U.S. Treasury bonds, a move that looks technical on paper, but is deeply political. And it came at the exact moment the United States faces a record deficit and a debt market under stress. The result: a tremor already felt in the corridors of power in Washington. To understand the magnitude of the hit, you need to understand what those bonds represent. Treasury securities are the foundation of U.S. credit, military spending, social programs, even the American dream of stability. They are the global symbol of trust in the United States. And Mexico just put that trust into question. What may seem like a reaction to Trump's tariffs is actually the final chapter of a plan years in the making. Mexico's central bank had long warned in its reports that relying on the dollar was a strategic vulnerability. An economy so tied to its northern neighbor could not continue without room to maneuver. And when Trump reignited the trade war and partially shut the border, Mexico decided the moment had come, not with speeches, but with action. The government began reducing its exposure to U.S. debt and diversifying its reserves. Part went to European bonds, part to physical gold, and another portion to instruments denominated in euros and pesos. It was a clear signal: the dollar is no longer untouchable. Washington understood the message too late. The Treasury Department issued internal alerts, and analysts warned that if Mexico continued down that path, other countries might follow. And that is exactly what began to happen. Brazil, Argentina, and Chile are already evaluating their own diversification strategies. The International Monetary Fund confirmed that, for the first time in 2 decades, the dollar's share in Latin American trade is declining, not by accident, but by political choice. The region is beginning to shield itself from U.S. volatility. Mexico's move is, above all, an act of sovereignty. For years, Mexican economic policy was shaped around Washington's rules. Each tariff change, each border restriction, felt like a reminder of dependence. Now the dynamic is reversing. For the first time in half a century, the United States finds itself vulnerable to a Mexican decision. Because if the country with America's most important border decides to pull back capital and operate with other currencies, the impact is measured not in rhetoric but in numbers. On the ground, tension translates into paralysis. Thousands of trucks stuck, factories interrupted, losses counted in billions per day. But while Trump keeps talking about walls and migration, Mexico is using a different border, a financial one. It is proving that real power isn't always in armies, but in who holds the debt that finances the most indebted nation on earth. And what unsettles Washington the most is that this move doesn't come from a rival, it comes from a partner. Mexico is not seeking a full break, it is seeking balance. A negotiation space where its voice weighs as much as the one in the north. And it's getting it. Every point of debt Mexico sells increases pressure on the U.S. Treasury and forces higher interest rates to retain buyers. A snowball that raises credit costs, hits American families, and squeezes the federal budget. Mexico's strategy is no improvisation. It is a measured response with a clear message. If tariffs are a political weapon, finances can be too. Trump believed he could punish Mexico without consequences. But the board flipped. The Mexican economy, far from collapsing, is reorganizing. Pemex is already experimenting with payment systems in euros and pesos. Private companies are diversifying their flows, and the country is building new settlement channels with European and Asian banks. The psychological impact is even greater than the economic one. For the first time, the White House openly acknowledges the risk of a regional contagion. If Mexico, a country deeply integrated into the U.S. market, dares to challenge dollar dominance without sinking, others might follow. And that is the scenario Washington fears the most. Because the power of the dollar depends not only on its value, but on the faith the world places in it. If that faith begins to crack, the entire system shakes. Europe is watching closely. Officials in the European Central Bank and in Brussels are already discussing whether the euro should seize the vacuum left by U.S. policy. In Asia, economies like Singapore and Malaysia are studying Mexico's strategy as a model of controlled independence. The message is repeated across every analysis. The United States can no longer assume its allies will finance its deficits forever. Inside Mexico, the move has triggered something unusual: unity. Business leaders, academics, and politicians agree the country needed to break from an unsustainable dependence. It's not antagonism, it's maturity. It's the posture of a middle power that understands the value of its geography and its weight in the regional financial system. For the first time, south of the Rio Bravo, Mexico is not reacting. It is setting the pace. Washington, on the other hand, looks unsteady. The Trump administration is trapped between two risks. Backing down would be a political defeat, but continuing the confrontation could trigger an unprecedented financial crisis. The tariffs are already in place, the border partially closed, and room to maneuver is shrinking. The administration can't escalate without damaging itself. And the problem isn't just economic, it's symbolic. If a partner like Mexico questions the value of the dollar, the illusion of U.S. hegemony cracks in front of the world. That is why the current tension is not a trade dispute. It is a fight over financial power, over who writes the rules of money in the Americas. And for the first time, Mexico is showing it can write those rules too. The big question now is how long the United States will hold out before seeking a negotiated exit. Because the blow didn't come from Beijing or Moscow, it came from its own border. And the message is unmistakable. The balance of power on the continent is shifting. The dollar is no longer the only language of commerce. And Mexico is no longer the obedient student of the North. Like and subscribe to Critical Point to stay ahead of the global power shifts.